a series of milestones. It seems like it's all in the air right now, not just the fact that in a few weeks, by some measures, we're going to reach the longest ever bull market. Merrill was talking about this last week, basically 14 more trading days. If you strictly believe a bull market is when the S&P goes up and does not have a 20% decline in between, which means that we're pushing more than 9 years here. It would beat the 90s bull market. But other milestones would also be, of course, we're coming up on the 10th anniversary of the financial crisis crash. There's going to be a lot of talk of how far we've come. And you guys were just mentioning Apple at $1 trillion. So all of this discussion of these milestones seems like it brings up the questions of, geez, how much more road is ahead? And I think you can answer each one of these in turn. And basically, the bull market at, the longest ever, I think, is really subject to a lot of different interpretations. A lot of folks will say in 2010, 11, 2015, you had these very sharp corrections that more or less did the job of a bear market, and we didn't start making new all-time highs in this bull market until 2013. So the clock might not have started in March of 2009. So that basically says that this bull market is young for its age, if in fact you still want to call it a 9 going on 10 years bull market. The other one is the 10-year gains since before the absolute pit of the crisis are really not that extreme. Basically, the 10-year trailing return of the S&P is 10.6%. That's good. That's about the long-term average. But normally at the end of a bull market, you're pushing 15, 20% 10-year trailing returns. So basically, you haven't gotten all that stretch over these 10 years. And finally, the $1 trillion Apple thing, you have to put it in context. One of those things is just by inflation and the size of the overall market, Apple's size is not particularly extreme. In late 1999, Microsoft, you mentioned, Joe, Microsoft was $620 billion at the end of 99. At 30 times sales and 70 times earnings, that's basically the equivalent of $950 billion right now. Relative to the size of the market and inflation. So Apple kind of should be here based on its economic size. It's at 4 times sales and 18 times trailing earnings.
Yeah, and I think that's been kind of the point, right? It's the $1 trillion value play, essentially. It's
the value play, and just $1 trillion is 4% of the market. And guess what? The largest stock in the market was often much bigger than 4% of the market.
But if this stock gets re-rated as a subscription-oriented, non-hardware business, I mean, think about what the price would be.
It would be enormous, and I have my doubts. I think everyone is a little bit premature in saying that that's really going to happen. I think that bolsters the valuation, but it doesn't necessarily mean we're going to transform this thing into Adobe trading at 40 times earnings because everyone thinks it's a magical subscription platform.
And of course, the software is tied to the hardware, right?
Always. It's just the hardware is the addressable market. Really.
Is that a backhanded compliment with Adobe there?
Adobe is an amazing stock, and everyone has decided that that's the model that they want to follow in terms of getting everybody on subscriptions.
Why? I mean, it's still fresh in my mind when Apple was going to introduce a phone. I was like, I've got a flip phone Motorola that's so cool that I'll never need a. What does Apple need to make a phone? And that's really what did it. I mean, I look at my kids, I look at the world right now, and everybody's walking around with a spare UNIVAC computer that they would have had, on the back, and it changed the world, and it
totally did. And so the benefit of that is going to last more than 11 years.
But it wasn't just an add-on product on top of the Macintosh. It is Apple. That's what I think about.
Totally. And it remains that.
And this is viewed in a political backdrop at times. If you go back to 1999 and do the compound rate of return, I mean, we hit. I forget what we hit in 1999, but if you do it from
S&P was 1,500.
You go up from there, it's like 4% a year. It's been an average, it's been a below average return from 1999. Now, if you go to 666 at the financial crisis lows, then it looks like a great return.
But
it's gone nowhere.
If you start the clock at the craziest moment in history for stock valuations, guess what? The forward 18 returns aren't great. From 1929, when did you get even?
Right, that's what I said about GE.
In the 50s.
I mean, if you look at GE at the bottom of the financial crisis at $5.50 a share, Immelt was a genius to get it to 13. But if you look at 60, you
got it to 35, and then it went to 13.
It's just, it just depends on.
No, absolutely. It's all the frame.